Hello, welcome back to Tab U. My name's Katrina Hindley, and today I'm joined by Sam and Jonny. Can I ask you all to introduce yourself, Sam?
Oh, I was going to suggest you go first.
All right, Jonny?
I'll happily go first. No, of course. My name is Samuel Morris. I'm a lending associate at Tab.
And our special guest?
My name is Jonny Doulton. I am the Capital Markets Director at Strettons at Chartered Surveyors.
And today the podcast is going to be all about commercial property investments. And we're going to be asking a couple of questions on what it is, what they are, as well as what it is, and everything else, and the future of the market, etc. So if we kick things off with question number one, which quite simply is, what are commercial property investments?
Commercial property investments are properties which are fundamentally income producing. Whatever anyone buys or sells will always be the property, the physical building, whether it be land plus building, plus a stream of rent or direct income.
And can anyone invest in commercial property?
Anyone can. People tend to directly invest either in their personal names or in limited companies. Sometimes people buy as part of syndicates. Or people might buy a REIT, so a real estate investment trust, which will be a PLC, so you'll be able to buy that on a stock exchange. There's a whole host of different ways of doing it, and all of my clients have very, very different profiles. So I'm on the brokerage side of things, so I help clients buy and sell commercial property investments from a whole range of sectors. So, it might be looking at retail property investments or distribution warehouses or hotels or supermarkets or shopping centres, a whole host.
What is the most quirky investment property that you have dealt with?
Quirkiest. I've seen funeral homes.
Oh, wow.
I've seen
Very apt.
sort of dental surgeries. We've had, honestly, if it's not a residential property, it falls into our purview, and dependent on what a vendor wishes to do, because, for example, it might be a property which is an owner occupied property, and if you're a meat processing business, and you decide that you want to raise some capital for your business, and you happen to own the freehold of your property, you might choose to do a sale and leaseback. So you would sell your property, but then you would lease it back to yourself at the same time. So you get the benefit of the property for the next, it could be 2 years, it could be 25 years. But then you sell the freehold onto a third party, and then they benefit from that lease. And dependent on the covenant strength of your business, so if you're a small business, then your covenant is relatively weak. But if you're a growing or a mid-size or a large business, then a sale and leaseback can be a very fruitful way of raising capital.
It's interesting. Quite an alternative route, I guess, to free up capital. Or, well, not an alternative route, another route. I guess, so you briefly touched on the ways that you can invest, REIT and stuff like that. Is that something that you would advise to people, or as kind of in your role, or is it mainly?
So typically my clients, when they come to me, they already know what structure that they're going to go down. So they might be a existing property company, they might be a developer, for example, and all of the land or the buildings that they buy go into their wider structures, or they might set up a special purpose vehicle, so a dedicated company structure for a individual property that they're buying. But every structure is different. Charities, for example, don't have to pay stamp duty. So if they buy a commercial property investment, then they get savings on their transactional costs as well, which gives them a little bit of an edge over the rest of the market.
And if we kind of move on to question 2, which follows on, what type of commercial property is most profitable?
So this is a horrible question as far as I'm concerned.
But I'm going to make a note of the answer.
Yeah,
that's
so
for sure.
The most profitable property is very difficult to quantify. What happens is commercial properties are priced on the basis of effectively 7 different factors. So what the property is, where it is, what the condition of the building is, what the income profile looks like. So if it's a single let property to Tesco with a 25-year lease, then that is seen as very, very attractive. However, you might have a multi-let estate or a high street parade where you might have multiple tenants, and then you're looking at, rather than the term certain on one tenant, you're looking at a WALT, which is a weighted average unexpired lease term, which blends all of that. It is, it's all, but yeah, just WALT. It's your blended income profile, and the shorter the income on the property, generally the higher the yield. So there is a reverse correlation. So the higher the price that you pay for something versus the rent that you're going to receive as landlord, the sharper the yield. So when people talk about bigger yields, higher yields, they're actually talking about paying less money for the property.
One of my questions was, why are long leases in commercial property attractive to investors? Is that the case, or is it actually just dependent on? So
typically, a landlord is going to want to get all of their rent, and any threats to them getting that rent means that they might potentially have a rental void. And then if they get a rental void, then the property turns from being a property asset into being a property liability, because the property will still have maintenance costs, and there'll be business rates as well. So effectively council tax for commercial property is business rates, and that is still payable even if the property is vacant. If the property is listed, however, then rates are not payable when it is vacant.
Why is that?
It's because of the way that the properties are deemed to be. If they're listed, then they're special buildings, by their history or their nature or what they are or where they are, and so the government and the taxman deems that they get various benefits, and that's one of them. However, typically with listed buildings, there are problems that go with them, because if you want to do works to a listed building, then certainly in this country, you have things like English heritage crop up and say, no, if you want to change those windows, then you can only change them for this type of window, and it will probably be triple the cost of what the most cost-effective way of doing it would be.
Do you see that separate? Not really part of the question, but do you see that catching up and being like, actually, it's fine, or is that going to be? Is it a fair thing that they're saying, or is it that?
I think so. I mean, typically these are buildings of merit in terms of how they're being constructed, and they may be Victorian buildings or Georgian buildings or whatever, and it might be part of the character of the local community and all that kind of stuff. So if people want, if the buildings have been listed for whatever reason, people are doing it because they want to protect the look and feel of their community ultimately.
And you kind of touched on, commercial property was everything but residential, or can?
So that statement was slightly misleading in that I will also look at mixed use developments. So, for example, if I was buying a building and the business plan was that we were going to buy a building with, short to medium income of 4 or 5 years, but then the business plan would be, as those leases ran down, you would then go in and seek a planning consent to vary the use type and get a different change of use. So you might be going from a retail department store, for example, and then saying, right, we're going to turn that either into residential flats, or we're going to turn it into student accommodation, or we're going to turn it into a hotel or something like that. So you need to vary the planning in order to do that. And sometimes you can do that under permitted development rights dependent on what the property is and where it is. But typically you would need to go off and get a new planning consent for what you were proposing to do with the building. And so there's extra costs linked with that.
That's some more layers to it, I guess. Any questions on that one?
No, I think you did ask exactly what I was going to ask, and you started off by saying that a commercial property is anything that's income producing and it's an investment and whatnot.
Mm-hmm.
And so I was thinking, do residential portfolios, investment portfolios, fall into that category?
They can do, and they tend to have a sort of slight niche of buyer, which is might vary from some of the other mainstream commercial funds. So typically, if you're a commercial pension fund, let's say that you're Legal and General or M&G or Aviva or someone like that, then they will have dedicated funds for different sectors of the market. So they might have a retail warehouse focused fund structure, or they might have a multi-let industrial structure. Some of them have residential fund structures. So I think Legal and General are one that do, for example. But not all of them do, and it sort of varies. But then also there are, it's all about the risk profile linked with the property. So if the properties are newly developed, very shiny, and with low EPC ratings and all that kind of stuff, then they will be far more sought after than residential stock, which is coming towards the end of its life cycle or in need of refurbishment, for example.
Understood.
Does that answer the question?
It does, because I think what I'm trying, obviously, to try and categorise property as residential or commercial, it's never just going to be a hard line down the middle.
No.
And so
for example, we are selling a commercial property in Wimbledon, which is a parade of 7 shops, and it's got flats above. Yeah. And with that parade, when we first took it on, there was a number of the flats that were let with both the retail on the ground floor, but then with the residential uppers, but all on the same retail lease. And then over time, the retailers tend to sublet the space above because it's not core to what their business is doing, and then you get residential tenants within them, and then others that have been sort of demised purely as residential flats, and then a purchaser of that scheme might consider buying all of the retail income and then selling off the various flats, to boost their overall returns, or they might choose to keep them long term, refurbish them, make the rents go up over time, and just improve the general.
There's so many ways of managing the asset to improve its value, income,
but again, it boils down to the landlord and what they want to do in terms of their business plan.
Yeah, absolutely.
And if they want to, some of them will just want to be very, very passive and just take the rents and not necessarily improve the building over time. Others are laser focused on making sure that their property is best in class and will stay best in class and get the best tenants and the best rents and all that kind of stuff.
And how often do you find yourself having to steer clients in certain directions or help them make certain decisions because maybe they're not as well versed in property and what might be best for the asset?
Yeah, I mean, lots of clients within Strettons' wider business have controlled their portfolios of properties for a long period of time, especially if it's been part of a family structure. If it's a family trust that might have a portfolio of 4 or 5 different assets, and so they might have some shops, they might have some warehouses, they might have some flats. It completely varies client to client, but very variable.
I'm going to stay on that point and actually go to the question of, do commercial investments in property require a lot of management?
They can do. They don't have to. So if it's a very long lease to the government, for example, and the rent review profiles go up in line with the retail price index every 5 years, for example, then as a landlord, if the property is a driving test centre, or if it's a government office building or something like that, you will get your rent 4 times a year. You'll get quarterly rents, and then hopefully over time, with that rent review structure, the rents will gradually track up, and your yield on your money will get better and better. But that's at the sort of top end of the market in terms of the government is the lender of last resort. They cannot go bust. So government leases are highly sought after on that basis, because they take on sort of gilt-edged dynamics in terms of gilt is a government bond. So it's still a property deal, but it's closer to a bond deal in terms of its structuring than a normal property deal. But then if you were to also look at a long lease to Tesco or Sainsbury's or Premier Inn or any large blue chip covenant, if they've got a long lease, and by that I mean probably 15 years without break, then there'll be very little direct management to do on a day-to-day basis. It's more when you're looking at multi-let properties or properties which are in need of refurbishment, or if you're wanting to look at sort of change of use angles and things like that, then you need to be a bit more hands-on in terms of bringing in more consultants and cost consultants as well. So you might bring in quantity surveyors to work out what it's going to cost you to turn that I don't know, shop into a range of other flats or whatever it may be.
So these are all very much things to do with what you can do to manage the value of the property and the asset.
Yeah, it's about managing the level of risk which is suitable to each client. And if my client, rather than being legal in general, a large pension fund where they are, because it's pension money, they are wanting a very low risk sort of variable on it. Whereas if it's a property private equity group or a developer, they're going to be sort of saying, well, the money that we're going to deploy on this property, we need to buy the property, do something to it to create further value, and then sell it within a 5-year window, because typically they get given pots of money and the ownership of that money for 5 years, and it typically would be like a 5+2 structure or something like that. And if they buy something and that business plan doesn't pan out, then they can get themselves into a lot of trouble very quickly.
Inevitably, there are going to be other factors such as the market, which could be working for them or against them. Yeah. The question I have is, how's the market doing at the moment? What is the commercial market looking like?
So the market at the minute is going through a bit of a transitionary period, because the last decade or so, interest rates have just been compressing and falling. The Bank of England and with sort of various government policies to protect the wider economy, whether it be following Brexit or then the pandemic, the government has sought to protect those with high levels of either personal or corporate debt by lowering interest rates, and so the interest rate environment has been artificially low for a decade, and it is now starting to rebase and effectively normalize. So when I first bought my flat in London a dozen years ago, I was paying interest rates of 5 3/4 or something like that, whereas most people would go, oh, that sounds a huge amount, but actually we're now looking at interest rates moving to probably 3.5% over the next year or so. And if that happens, then the arbitrage, the difference between where the base rates are and what the property yields are, tends to drift up slightly. So pricing will move out. The pricing will get slightly softer relative to what it was previously. But there is an awful lot of money that has been has been printed over the last number of years, running into the trillions globally when we're talking about the pandemic. And lots of that money went into the bond market, some of it went into the stock market, some of it goes into the property market, and some of it's just sitting in cash. And my personal feeling is that proportionally there is a large weighting to cash right now because people are nervous, they're not quite sure where to deploy their money. And that is the same for individual households to the largest private equity groups out there. There is uncertainty. There's like a sort of fog of war. People can't quite work out what they're going to do. Later this week, there's going to be a government budget or a mini budget, but I think it will be fairly stimulative in terms of they're talking about changing stamp duty, and they're talking about cutting corporation tax and a whole host of things, which will give both individuals and corporates a bit more breathing room and a bit more certainty as to what they're going to do. The last 6 months has been sort of dominated by the fall of the Johnson government and a large question mark as to what follows. Mrs. Truss has only just come into power, and we're now looking to see what she's going to say next to the markets, because that will then dictate what people choose to do.
So, given everything you've just said and what's happening with the markets, should we wait until the mini budget's out, or is commercial property a good investment right now?
Commercial property is always a good investment. I would caveat that with understand what you're buying. Lots of people, I think, make an error of deploying capital into parts of the market that they don't fully understand. So, for example, retail property over the last 15 years has been hugely disrupted by the changes in shopping habits and online spending.
Yeah.
So that has caused a lot of pressure on local high streets, and rents have been rather than rising, have been falling backwards, and the yields that the market has been willing to pay for those properties. When I first joined the world of property, the best properties, in all of the nice market towns would command yields of 4.5% to 5%, and now you can get those same properties with the same tenants, probably with slightly shorter leases, but you're probably getting almost doubled your yield. So rather than 4 or 5, you might be getting 7 or 8%, dependent on the lease and where it is and what it is and what you have to spend on it moving forwards. But conversely, there have been winners from that wider trend. So all of these online businesses have had huge demand for warehouses. And so warehouses for the last decade have been the out and out stellar performer in portfolios. And it doesn't matter if you've got a relatively small warehouse, it might be 4,000 or 5,000 square foot, or it might be 1 million square foot let to Amazon or someone like that. The yields on those have compressed down to, there was deals last year that were going in Greater London on deals of scale, and this is 50 million plus, of sort of going below 2.5%, things like that. Whereas those same buildings 10 years earlier, you would have been buying them at 7-8%. So as the yield compresses, the capital values go up dramatically. So owners of warehouses over the last decade have done particularly well, and they've also seen lots of rental growth. And the rents on the high street have been going backwards, but the warehouse rents have been rocketing. And
so if you've got a warehouse, you're in a good position right now.
Yeah. But
do you think that's going to maintain its kind of growth, warehouses in particular? And then I guess separately to that, where do you see the...
So warehouses, I think that the tailwinds that they've been benefiting from are still there. I think that there's a shortage of warehouse space. Obviously the warehouses need to be in the right places. If it's a warehouse in the middle of a Yorkshire moor, it may not get the same demand from tenants as something within the M25.
Yep.
I mean, Strettons are very blessed that our sort of core catchment is North London, East London, the city fringe, the square mile. So our sort of patch and manor is very much going to benefit off lots of these tailwinds. So we are very, very lucky like that. But it is a long-standing business that's been going 90 odd years, and so yeah.
And where do you see the future of commercial property investment?
That's a huge question. Where do I see it? Well, I think
what trends are you seeing then? I guess we touched on warehouses and we've seen the retail.
I can make the assumption that warehouses have gone up in value, like you said, because of tenants such as Amazon, and people are probably wanting to store things that are going to be shipped out because of e-commerce and things like that. There's all these reasons why that's gone up. But seconds, I mean, I'm asking the same question as you. What do we think could be next? Did anyone see the warehouses being a really good investment and unfolding in this way? And what could
so is the warehouse trend going to continue at the speed it was? I'm not so sure, because I think that there are a number of tenants out there that are somewhat stressed by the rental growth that has been placed on their shoulders by landlords who have been just been swamped by demand for their buildings, and I think that there is a tipping point where the direct economics of tenants paying rents, the rents have to be sustainable for the businesses that are using those buildings. And I think certainly within warehouses, the rental growth rate has been charging for a period of time.
And I presume that's
effectively a
more
decade.
down to demand than anything else.
And it's just a classic supply demand mismatch. And I think there are industrial developers who are scrambling to find sites so that they can build new buildings to soak up more of that demand. But I think that is starting to calm down a little bit, and there are other areas of the market that are coming through. I mean, certainly student accommodation has been very popular. So there are some fund managers out there who talk about beds and sheds, and the beds might be student accommodation. It might be BTR, so build to rent as well. So a residential format where these tall resi blocks are being developed, but rather than selling off the flats one by one to you and all your friends, the owners purposely choose not to sell those flats and to hold those flats as a long-term stream of income. So people call it either BTR or PRS, so private
rental sector.
Rental sector, exactly. Both of those.
And what about kind of ESG products and as commercial investment? I know that there's a lot of capital out there at the moment, and
so ESG is at the top of lots of fund managers' sort of buying criteria, in terms of it's something that they're very focused on thinking about in terms of the sustainability of buildings that go into their portfolios. I think that there's been a lot of concern from fund managers of offices, for example, that they're going to have to do major works to their buildings to keep their buildings compliant for energy usage and so on. And as the government has had campaigns to get us on a path to net zero by 2050 or whatever it is, that has had lots of follow-on effects, and so the environmental part of that is typically in the running costs of the building. So if it's a best-in-class building and it's been very carefully designed and it has very clever heating systems and drainage systems, and they've used lots of renewable fabrics within the construction of the building, all those if I was a fund manager at Aviva and I could buy a £50 million office, one of which had just had everything done to it, and then the other one had a similar profile, but I was going to have to spend millions of pounds on a like-by-like basis, I'm always going to go for the one where over the cost cycle of the building, my costs as landlord are going to be lower. Yeah. So, I think people have been thinking about that far more within the last sort of 2 years, 18 months, something like that. And certainly the EPC scores, so the energy performance certificates that you get on your buildings when you buy them, look closely at those and make sure if it's a low scoring building, so that it grades from A to G or something like that, and if you're in E, F, G, I would be concerned and just think about, am I buying this with a business plan where I'm going to fix that moving forward? And there's no problem with that. Yeah. But also, if it's a particularly low scoring building, that's also going to have sort of follow-on impacts for things like insurance and other wider maintenance as well.
So I guess from a kind of, we mentioned this kind of sale and leaseback thing at the beginning, that might encourage more business owners to invest in ESG standards for their building because they can probably get more money for their property by the end of it.
So, I mean, if you're a medium-sized business and government policy is sort of saying that you've got to spend £10 million on your buildings, but you don't have £10 million to hand, but you've got a building that you bought 30, 40 years ago, and you, relatively speaking, would have paid a relatively low price for the land. You may have developed the building yourself, or you've done various works to it over time. There are lots of businesses that we talk to on a regular basis who are sort of saying, well, our overall business cost base is rising. What are we going to do about it? And sometimes sale and leasebacks is the right way to go. There are all sorts of nuances with that, but we're always delighted to talk to clients that are thinking about that and help guide them in their strategy and help tell them the best lease structures and things to be conscious of as part of that process, because there are times in the past when businesses have done sale and leasebacks, but if the rents have been set too high, or the rent review structure is unfavourable to the tenant over the long term, they can give themselves a huge amount of pressure moving forward. So without going into names, I can think of businesses, large PLCs that they've raised 200 or 300 million, but as part of that, they may have granted themselves a 20-year lease, and they've sold the freehold of their property to a third party. But if the rent goes up at 3% annually, for example, and year on year it's going up 3%, and it just keeps on compounding. But then there's a major change in the business cycle in the backdrop, going back to what you were saying, Sam. And the turnover of the business drops off, or the profitability of the business drops off for a whole host of different reasons, but they're still saddled with this financial commitment, and they have to meet the rising costs. So their profitability is going down, but their cost base is going up, and these costs can get very significant quickly, especially on a transaction of that size.
And the clients come to you with these issues to try and help brainstorm solutions. And
let me just jump in, and
I had a feeling,
because it's the question number 5 is what is your role within Strettons?
Yeah, so fine.
If we kind of tie that in with what Sam's discussed.
So yeah, I mean, I'm head of capital markets at Strettons. So typically sale and leasebacks fall into my domain, as does buying and selling. Albeit Strettons has a prominent presence within the world of auctions as well, and we have agency teams dealing with city fringe offices and warehouses and retail units and a whole host. And so those teams also transact, but it tends to be at a lower property asset value than some of the things that I tend to deal with. So typically the things that I are more focused on, it starts at 2.5 to 3 million, rising upwards, and there's no sort of top cap on where that goes to.
I'm curious, just for myself, what's the largest asset that you've transacted on or managed for
So,
a client? Largest single asset.
So the largest transaction that I've worked on was a portfolio. So rather than one
not a single asset. but go on, it sounds interesting.
But it was a portfolio of petrol filling stations with convenience stores. So a client of my former practice were very close to Chevron, and we teamed up with one of our clients to acquire a portfolio of 120 petrol filling stations. This is, I don't know, a dozen years ago or so, and we bought this package of 120 sites, and they were bought with vacant possession, so there was no income. But the business plan was that we were going to take these properties and convert them, work the planning and refurbish them and extend them to turn them from petrol filling stations where you could buy a newspaper and some chocolates and a packet of cigarettes in typically a sort of a kiosk of 700 square foot, and then you got the petrol pumps, into a full format forecourt convenience store. So you'd be putting a small supermarket on these sites,
which we see so often now.
And now, but back then it was very new, innovative, all that kind of stuff. And my former practice were very close to Summerfield, who then got bought out by Co-op. And we knew that Co-op wanted to move into, Summerfield wanted to go into this space. And so we, of the 120 sites that we were buying vacant, we knew that we could let 90 of them straight away.
Wow.
And so we put 20-year leases on 90
of them. Wow.
And then there was another 30 sites that we then sold to developers and to the petrol trade as well. But then with the core 90, they then went through a program of works and refurbishments, and so like the portfolio when we bought it for the 90 sites was circa 100 million, but then by the time that we'd finished with it, it was closer to 200 million.
What time frame was that?
So by the time that all of the works to the portfolio had been concluded, it was just before the great financial crisis.
Oh, wow.
So it was really a very interesting time, and we had launched the portfolio with a price tag, I think, of 180 million. We had proposals at 200 million or so at the time, and then on the Monday we were due to present the proposals back to our client to say, right, we think so and so is the right person to buy all of this as a winner, and here's their proof of finance, and here are their debt terms, and so on. But on the Sunday, Lehman's went. And then all of our bidders, and we had about 8 different bidders or so that were all at, call it 200 million. And we then, all of those bids fell over because they couldn't get the finance terms that they wanted from the banks, because the banks stopped lending off the back of Lehman Brothers collapse, and all the banks are then sort of looking around at every other bank, deciding is our business still sound and secure and all that kind of stuff. So that was a huge whirlwind, and then we then spent the next 2 years effectively breaking up that portfolio of 90, and then breaking it into more bite-sized chunks. So we sold smaller portfolios of 10 properties at a time, or 4 properties at a time, or even single deals all over. But ultimately, we still got to the capital sum of 100. I think it was about 190 million by the time that we were all done. But it was through a massively turbulent period in the market. But because the leases that we had got from Summerfield were 20-year leases, they were long, strong, defensive profiles of income, which meant that the market very much were chasing that for wealth preservation as much as wealth generation.
Well, there you go. The question was, what do you do? And I mean that's a great example.
Well, it was a roller coaster. It really was.
But to have that that have that knowledge and understanding of how to manage a scenario like that? Are there certain qualifications or studying or learning that you have to do to put yourself in a position to be able to advise clients on these things?
Typically, most investment agents are chartered surveyors, and people go off to university. They do a property course which is RICS. RICS accredited, and then once they've got that, then they come back to the market as graduates, and then they can train for several years with a wide range of businesses, and then after that time, then they sit their APC, which is their assessment of professional competence. And if they pass that, so there's a written part, and then there's a panel part where they have to present to a panel of effectively 4 judges, or like chartered surveyors that are there, and then once they've done that, then they become chartered surveyors.
And so, is that the route that you took into the industry?
So personally, I didn't take that route. I was on that route, and going back to the portfolio sale that I was telling you about, I was working towards becoming chartered when the great financial crisis kicked off.
Oh wow!
And then
you had your work cut out.
I was in the midst of trying to sell this portfolio of 180 million, and actually there was a member of my team who was made redundant during that time, and it was just focus on the job, get that done, and actually over time, my personal CV sort of got padded out by doing more and more deals. I got promoted more and more throughout my previous business. So when I joined that business, I joined as a graduate surveyor, and they had 7 rungs. And then I went up to partner level, which was salary partner, which was sort of level 6 or 7. And then from there, I then got poached to do my current role with Strettons.
So not
not qualified, but there are
officially qualified.
There
qualified
are
in your
some very
though.
prominent agents that are not qualified. However, I'd say most investment agents are.
So is it more? I guess, kind of on the final question before we go, is it more difficult to get where you are now, given that the qualification? So, what you got there through experience and obviously a really long CV of all these wonderful projects. Is it? Would you say it's more difficult to kind of get on board of these really difficult projects now, without having that, or do you think there are still some who kind of get through the net?
It's difficult. I think that given the hurdles for people coming through into surveying today, I think that if for example you're wanting to go and to train as a investment agent and then become a property fund manager, for example, if you want to be a fund manager, you absolutely have got to be chartered. Yeah. But there are other qualifications and there are other skill sets that you need in order to do the job well. Your financial modeling's got to be very strong. Yeah. You've got to be very engaging and understand how your clients think and what risk profiles that they're willing to take on the various deals that you put to them. You need to know how to manage processes and teams and all that kind of stuff. And so obviously investment agents work very closely with a wide range of consultants, from planners through to lawyers and quantity surveyors and architects and a whole host of other skills that feed into the wider property world. But I think that having a strong insight to what you're doing, enjoying what you're doing. I think lots of people go down career paths where they think, I'm going to do this because I'm going to get a large salary at the end of it. I think that you need to choose a career that you like the basic framework of what it's all about. And for me, although I'm buying and selling property for my clients, really it's the clients and the personal dynamics that I like the most.
Well, I'm going to end it on there on a nice note. Thank you for joining us.
Thank you
It's been
very
really
much for having me.
interesting. Thanks for coming back, Sam.
Oh, thanks for having
Welcome
me.
anytime. Thanks to all of our listeners, and I hope you enjoyed the episode. Don't forget to like, subscribe, share, comment, and I will see you next time. Tomorrow. Well, not tomorrow. I'll see you next time for an architect. Have a good one. Bye.